Welcome, everybody, to today's webinar on warehousing, inventory, and third-party logistics. It's part of the BISG Lunch and Learn series. I'm Brian O'Leary, the Executive Director of the Book Industry Study Group. And we're fortunate today to be able to welcome David Hetherington of Books International to talk about his perspective on these issues. I spent a lot of time, obviously, in his career thinking about the important role that warehousing and inventory play, but also in the last several years on the growing trend around third-party logistics providers. David, thank you for making the time today. I know you've put together about 15 minutes or so of thoughts on this that are going to get us going. And folks, if you have questions that you want to put into the chat, we'll pick those up and kind of have a conversation after that.
Okay, so shall we get started?
Let's go.
Okay. All right, ladies and gentlemen, first of all, thank you for the opportunity to speak with you. I encourage you to ask any and all questions that occur to you, and I'll do my best to answer them. And if I can't answer them on the spot, perhaps we can have a follow-up conversation. So let's get started. All right, so introductory slide, right? So third-party distribution has been a fixture of the publishing landscape for some time, but COVID-19 accelerated interest in this as an alternative to traditional distribution for a variety of reasons. A primary reason being it is a way of mitigating the risk involved with having a captive operation. When you are managing your own operation, there are a number of risks that everyone should be mindful of. And I think what COVID confirmed is that there are options available that you want to give some thought to. All right. So again, it's a captive operation as an alternative strategy. Third-party distribution as an alternative strategy to a captive operation. And also think about third-party distribution, even if you are in that space already, that one of the things that you want to do is to periodically test your existing third-party relationships and whether or not there are new services that you'd like to add to the portfolio, or you have some service concerns that may make you think about making a change. All right. The definition of third-party distribution is very situational, and it depends on the publisher's objectives. But at minimum, third-party distribution includes picking, packing, and shipping of inventory. And depending on your particular needs, the portfolio of services that might be included could be expanded to include sales and marketing, order to cash and customer service, pick, pack, and ship, as I mentioned, and book manufacturing. We'll spend a little bit of time on those last two pieces, but again, there's a broad range of services available. And one of the things that I would encourage you to do is to look at whether or not all four are important to you, or they might potentially be important to you. And you think about, if you're deciding to make that move, you structure an arrangement that allows you to expand the breadth of the services over the course of the relationship. Right. So why the increased interest? Well, traditional distribution, that is the publisher-managed warehouse, involves significant fixed costs and requires a predictable level of activity to support full cost absorption. I think as publishers, there may be this tendency to be a bit too optimistic about the volume that will come through the facility. Or the facility's capabilities to handle a different range of distribution services. Case in point being, I'm sure that everyone on the call may remember the Amazon drought that we went through in August of 2022. Well, what happens when you have that warehouse and you've got no business coming in from Amazon, or much less business coming from Amazon, but you still have those fixed costs? What happens in the case of the pandemic, where you had diminished activity in some operations, or your warehouse had to be shut down, but you still got the heavy expenses associated with ownership. So as I said, the pandemic and volatile channel behavior changed the rules. Many of the changes, I believe, are permanent, and the degree of change remains to be seen. Again, not to overplay the Amazon point, but Amazon's temporary exit from the business of books. There has been some recent speculation that Amazon is embarking on a similar path shortly, right? Another factor here is publisher focus on cultivating business to consumer relationships with their readers and the associated benefits. We'll talk about the benefits in a moment, but the idea here is that many publishers have decided that they want to own that relationship with the consumer that they have previously turned over to Amazon. They want to recapture that. They want to use it. They want to cultivate it. And think of it from this perspective. If you're shipping 100,000 books in cartons of 25, that requires one sort of capability. If you're shipping 100,000 books in single copy sales, that requires an entirely different capability. If you're making that transition to emphasize B2C relationship, do you have the capability to adapt for that new business model? There's increased interest in the digital delivery of ebooks. Many of these third-party providers have the capability to help you to deliver that, but also digital delivery and ebooks can mean that there's less volume going through the facility. So the rationale that you built the original business case on, may be subject to some change. Other considerations here are, as open education resources become more pervasive, as inclusive access programs become more pervasive, as open access becomes more pervasive, and demographic changes. As an example, the higher education division is what's been referred to, facing what's been referred to as the demographic cliff. In 2025, there's going to be less volume going through the facility. And the question becomes, will you have enough volume to absorb the cost? Could you approach that process of fulfillment in a more constructive and cash-conserving way? Okay, so again, why the increased interest in fulfillment, third-party fulfillment? First of all, outsourcing provides undeniable advantages from a cash and risk management perspective. There are a whole raft of fixed costs which disappear when you outsource. From a risk management perspective, you simply have fewer challenges to deal with. Let's just think about the real estate risk. So you're in your own facility, and it's a rental facility, and suddenly you have a new landlord and you find your rent skyrocketing, or you find the landlord has another alternative for the facility and you have to relocate. All kinds of challenges can come up here, right? Business with outsourced services, and here I'm referring to fulfillment and technology services, are often viewed as more attractive acquisition and merger candidates because it allows the acquirer or the merger partner to uncouple them from an existing relationship without the heavy expense of exiting from an owned facility. Outsourcing makes a bolt-on of acquired properties much easier to effect. So if you're thinking about long-term strategy for your business, if the plan is to put it up for sale, or you're in the acquisition mode, right? Again, I would encourage you to give due weight to the fact that outsourced operations are much easier to manage and combine than when someone has their own fixed facility, right? Combined with co-located manufacturing, what I refer to as the one roof strategy, the outsourcing upside increases significantly, and it allows the publisher to accelerate their transition from a print first, sell later to sell first, print later models. Many of the organizations that are in this space have manufacturing capability. I would encourage you to look at those organizations because of the upside potential, and also remind you that the longer your supply chain, the more links in your supply chain, the more vulnerable it is. So if you're printing outside and then shipping to your warehouse, you've got three links: the manufacturer, the trucking company, and then the warehouse. But if you're printing under and fulfilling under one roof, you have one link to deal with, and I think that has remarkable value under the right circumstances. I think that the other point I want to mention here, and I suspect I'm I'm preaching to the converted is that you really want to move your business from a fixation on unit cost to a total cost of ownership. That is good for business. Looking at the total amount of cash that you're going to be spending and managing the business from that perspective rather than obsessing with unit manufacturing costs. Okay, so when we compare the distribution models, right? So let's look at each column. In the traditional distribution model, you have a fixed cost for real estate, you have ongoing staffing and technology spend, right? For maintaining that, you have the cost of upgrades to systems, you have security related to information technology, a whole raft of issues here that are expenses going out of the publisher's pocket for a fixed owned facility. You have higher fixed costs, unquestionably. You have the labor challenges to deal with, and anybody in book manufacturing and warehousing right now can say, with absolute certainty that we are all dealing with labor challenges in the current marketplace. You have uncertain cost absorption. Will you have enough volume going through the plant, the facility, to recover to absorb all of the costs that you're dealing with? If not, your expenses are going to wind up being higher than they might otherwise be, right? Modest economies of scale, right? And it burns cash. On the other hand, from the outsourced model, you have no real estate to deal with. You have limited technology and staff costs to deal with because you've outsourced that to the provider. You are paying as you go, rather than having the large payments, as I mentioned before, with the existing facility, right? You have opportunities for time and process. You have significant opportunities. You have a predictable cost depending on the model being used, and it is conserving publisher cash. At a time when interest rates are at 8.5%, managing cash has taken on more importance than ever. So I would, again, encourage you to look at it from a variety of perspectives, not just the cost of the facility. Right. Outsourcing considerations, which I think should not be underestimated, is that outsourcing is not without some risk. And the risk is a function of the breadth of functions that you have outsourced. Right. So just bear that in mind. That this is not a panacea. Things can and do go wrong, but typically they correct themselves in short order. The timing is crucial. If you're going to do this, you want to make sure you do it with sufficient time given to your high season, and that you allow for inevitable schedule disruptions. It requires careful planning. It requires dedicated publisher resources, and it requires clear, constant communication of your expectations to your provider. Don't leave anything to chance, all right? There are one-time costs that you need to bear in mind as well. So you have cash costs, which is out-of-pocket cash, and non-cash. So if you're transferring your inventory, there's freight. If you have to write off inventory because you don't want to move slow-moving stock to the new provider, right? There are costs associated with that. You may have severance involved when you terminate your existing staff, and then you may have write-off of unamortized capital investment that has to be considered. So cash expenses and non-cash expenses. And the other thing I would encourage everyone to consider is the cultural impact on your organization. Both the publisher and the provider should check references. So as part of your process here, you want to make sure that you do your due diligence, and the provider should be doing their due diligence. Some relationships may appear to be terrific on paper, but when you get into things, it becomes a little bit more stressful. So I would encourage the providers to check the references of a prospective customer as well. Okay, so on this chart here, what I've done is I've listed some outsourcing providers that I'm familiar with. These are organizations that we run into on a regular basis. All of them, should be considered in view of your particular needs. And so I think I've got 12 or 15 here. These are all names that are familiar to many people. And I will apologize in advance. There are some folks here that I left out because of space considerations. But as you can see, there are ample, there's a very robust marketplace, and you have opportunities here to search and consider. And I think, so my closing thoughts, as a publisher, I think you want to focus on core competencies. Is warehousing one of your core competencies? Is that a critical success factor that gives you a distinct competitive advantage? I would argue that it is not a distinct competitive advantage unless you are someone like an Amazon. I would encourage you to think long-term. Do you do fulfillment services, providing your own fulfillment services, fit into your strategy and priorities? Or could you redeploy the resources you now associate with that into doing other things to make the business more successful and turn that responsibility over to a third-party provider? Very important point here. All right. The next one, understanding the provider's business model. There are typically two service models available. Number one is it a service where you are charged based on the particular action taken by the service provider? So when the books come in from a book manufacturer, is there a receiving charge? When the books are returned, is there a charge? When the books are moved from one location A to location B, is there a charge, right? This is what I call the menu approach to pricing, all right? And then there's a sales approach to pricing, which is the provider asks for a percentage of the sale as a compensation for the services provided. Most organizations have a combination of the two, but what I would encourage you to do is to make sure you absolutely understand what's involved. And I would also encourage you to prepare test calculations. Set up a sample month, right? And of books being received, books being returned, books being shipped, and create your own test calculation, or ask the provider to answer that question for you by giving you a spreadsheet and dropping in the appropriate numbers, right? Another point, and again, I cannot emphasize this too much. Do not make your selection based on arithmetic. Qualitative considerations are critical. With all due respect to some procurement professionals, one of the things that we often see is that decisions are made by arithmetic, and the needs of the publishing operation, prospective changes that might be on the horizon, do not get appropriate weight in the evaluation. You want to consider what-if considerations. What happens if this goes wrong? What happens if you decide to change strategies? What happens if you decide to put more emphasis on your business to consumer activity and less on bulk shipments? All right, important consideration going forward. Right? You also want to consider the size of the pond. Right, when you go into one of these relationships, you are not going in as an isolated organization. You are part of a number of other publishers who will be with that provider, and you want to make sure that your size and their capabilities fit well. You want to make sure that you're not a small fish in a very big pond, or that you're too big a fish for the pond that you're going into. Again, so evaluate this carefully, weigh all the considerations, right? And use that as part of your evaluation criteria, right? Customer relationships are valuable, right? So especially as more publishers are building business to consumer capabilities, you may want to consider holding on to the order to cash piece of the business so that you can control that relationship with the consumer. That has great value. I'm going to hark back to the point I raised earlier. If you're considering selling the business or buying a business, your relationship with consumers, your direct relationship, the relationship that you cultivate has value, and you want to be careful not to turn that over to another organization if you can extract more value from it than would otherwise be the case. If you're already outsourced, I would encourage you to test the waters and examine alternatives as your contract renewal date approaches. I think that's just good business. And the final point here for me, and again, this is a point I want to emphasize, is that fulfillment organizations are facing cost pressures with labor, packing materials, energy, transportation, and infrastructure investment. Everybody needs to make a profit. So it's not helpful for anyone if you, as a prospective buyer of these services, are trying to squeeze every last penny out of your provider. People have to make a reasonable profit if the expectation is that you will be investing in the business. So please, I would ask you to keep that in mind as you go forward. And my contact information is here. If anyone has any questions, I think Brian, correct me if I've got this right. We are recording the session, and we will make the slides available to everyone who gets the recording. Right, and with that, I would open the floor for discussion.
Why don't we leave up your contact information for a moment while we start to go through some of the questions? Okay. But then I'll take it down, and we'll have everybody see each other.
So David, there have been just a ton of questions coming in. I'm going to start going down and reading through the questions, but once the contact information comes off, then if you've got a question, just feel free to just jump right in and ask. So one of the first and actually one of the last questions was the integration, systems integration. Is that with EDI transactions? Is it with flat files? Is it via API? What's the usual way of connecting with a 3PL warehouse management system?
Typically, it is with EDI is perhaps the most pervasive way, but depending upon the ERP system that you are using, right, there can be a direct connection there as well. But that's something that I would encourage everyone to test, and to test rigorously. And the more time that you can spend on that, I think the better off that you will be.
Seems like most of the CIOs that I've been talking to recently prefer the API connection versus EDI, which I think they think is a little old-fashioned. So,
well, I think you're right. It is old-fashioned, but you would be surprised at the number of organizations who are still communicating with soup cans tied by strings. So it's I think we have to contend with what we get.
You mentioned the service-based or menu-based pricing versus the sales-based pricing. But on the menu-based pricing, I've seen two different alternatives. One is like a transaction cost for those things. The other is a cost plus. Any thoughts about like when you would go for which?
I really think it's situational to the business. It's really incumbent on the publisher to understand what's going to be happening. So, some companies that, let's say you've got a front list of 600 or 700 titles coming in. It's going to be received at the warehouse. You want to evaluate what's the best model for your business. I mean, I do have to say, as I'm in the 12-step program for recovering accountants. And, one of the things I will tell you is that there's nothing more painful than going through an invoice from a distribution provider at the end of the month that's got a whole raft of transactions, right, that are really difficult to prove that they've happened. I'm not suggesting that there's anything untoward going here, but it's a budgeting nightmare, right? So if I'm putting a budget together, it's a lot easier for me to put a budget together if I'm paying a percentage of sales, and I know I've got a $5 million business and I'm paying X amount as a percent. I have a pretty good idea of what my costs are going to be. If I'm doing it on a transaction basis, it would take a clairvoyant to really put those numbers together with any degree of accuracy.
Yeah, Nicholas maybe had joined you in the 12-step program there because he commented that it was just a nightmare to do to go through the invoices. Nicholas, do you have anything else you'd like to comment or add to that?
No, I mean, I think I've worked with both, and I can see the advantages of both. I think it's probably in the end costs you less if you go for a transaction thing, but it's just a question of admin time and how much management time you want to spend, and it can get very argumentative with a partner who you're trying to keep on good terms. And there's all sorts of hidden things that come up. It's like who's responsible for moving inventory, who's responsible for bulk, what happens if you have a bestseller and suddenly people need to allocate more. It's just an endless stream of arguments that can get difficult and time consuming. And therefore the net sales, I think, cost you more in the end from my experience, but it saves you a lot of aggravation and a lot of hidden admin costs that you can't really see. So I think that's my experience over the years, is that I would always go for that option.
Great, thank you. Also, managing the relationship. When you outsource, you still need somebody inside to manage that relationship, or like what kind of staff, David, would you expect a publisher to maintain if they outsource their distribution?
I think that there's someone who has to be tasked with managing that relationship. So typically, in the relationships that we engage with at BI, there's a senior financial executive. So, for instance, Tom Allen is on the phone from Sadlier, right? So Tom is the CFO and chief operating officer. He's involved in the conversation, at particular times of the year. The chief executive officer maybe, or the customer service maybe. So there's a group of people who work with the business on a day-to-day level, perhaps in customer service on both sides. But then, the relationship is not exempt from C-level attention, particularly as you get closer to your critical time of the year.
Exactly right. Well, now I know why you've got the gray hair, given Tom's involvement in this.
Yeah, but I've got the gray hair. He's
losing his. Kind
Yeah,
of
I was going to say, wait a minute. He came out better than I did.
So do you see that the volume of 3PL transactions picking up, or the number of RFPs picking up or declining over the last few years?
What we're seeing is a lot of activity. I think the issue here is accumulating the information to put together a credible request for proposal, right? So publishers need to understand the micro detail of what they do. And on top of that, they need to understand where they want to take the business to help us put together, a credible proposal. No one likes surprises, and one of the things that we find perhaps, the most challenging is what I refer to as perhaps over-optimistic sales expectations, right? Publishers often, I think, come up with volume numbers that perhaps may be a bit more optimistic than the reality of things, especially in this environment. I mean, not everybody has a Britney Spears, under their belt. So I think, you need to take it with a grain of salt.
I think there's been an uptick in people looking for third party with print on demand becoming so much of an integral part. And you sort of referred to it, David, a bit with manufacturing. But if you do have a lot of print on demand and you find a distributor who has the machinery in their facility, then you're saving yourself, I think, quite a lot of time and trouble and money, and it makes a lot more sense.
I would absolutely agree. The only, I think, perhaps distinction I would make there is that, print on demand, I think it to some extent has become an unfortunate acronym. And the reason I say that is that, print on demand sort of implies that every time you have a sale, you're going to print the book. And I think that there are other inventory models. Well, I think some people see that, right? There are other inventory models where you are going back to press more frequently for larger quantities, or you're doing quantities that you might have otherwise done on offset. But again, it's the idea of having the print capability and fulfillment capability under one roof.
Yeah.
So Andrew Van Sprang mentioned that he saw the number of RFPs increasing. Andrew, do you want to comment on that and what company you're with? You might be on. There we go.
Yeah, here we go. Yeah, sure. I'm with Maple Logistics, and yeah, we've definitely seen an increase. I think a lot of it has to do with some of the things I wrote there. Some of it's labor force retirements at some of the warehouses, where getting new people in and trying to get them trained was not something that the current group was looking to deal with. So they were looking to maybe go outside. In some of the cases in the university press marketplace, sometimes it has to do with pressures from the schools to retake the buildings or the space that was being used for the fulfillment services. And that's kind of put things out to RFP. But yeah, we've seen a definite uptick. The other piece is, I think, the kind of distributed model of trying to reduce in some cases, I saw something up here about, sustainability, carbon footprint, being able to be closer to where more of your publishers are, has put some people out into the idea of separating out and using multiple warehouses around the country in order to get the best service, best pricing for shipping as well.
Very good. Thank you for that answer. Someone in here asked about when you do this, do you normally use a logistics consultant to help with the process, or do you manage it all internally? David, any thoughts?
I think it's, from my perspective, we've had occasions where you do both. I think a logistics consultant certainly can help, but I think also that if you've got an experienced warehouse and back office operation, they know what they're looking for. And I think what you want to do is, to make sure that it's a proper balance of both. What I find sometimes with the logistics consultants is that they get a little bit further into the weeds. So I'll give you an example. We had a proposal that we got some months ago that we were asked to reply to, and part of the response, they wanted to know what sort of pest control that we had and what kind of insecticide we were using. And I understand the implications of it, but really, is that a factor that we're going to weigh in making the decision? So I think there's a little bit, sometimes the logistics consultants turn over a few too many rocks. But again, that's my own personal opinion.
David,
You know how these consultants are, Ken.
I would add from bitter experience, David, that you have to be careful about your relationship with the distributor you're leaving, even if especially if it's your own warehouse, because they're not really incentivized to do a good job on packing the inventory. And I've had a case where the inventory showed up in an awful state of just thrown in, and no packing notes, no nothing, because they were angry that they'd been left. So it may be worth having someone, be it a consultant or internally, just supervising the packing at the warehouse you're leaving, because it was really nasty and it became very, very, very unpleasant. So it's just worth watching that one.
So there was another series of questions and discussions about splitting product lines across multiple partners, or even splitting different channels. So like non-trade direct might go via one distributor and trade might go via another. David, do you have any thoughts about that?
I have to say that, I've been at this for a bit. right? And I've never encountered in that. I'm a firm believer, in the sort of the Simon and Schuster model. I'll use the expression. It may be a bit rough for some people, but at Simon and Schuster we used to say one neck, one noose, right? So that's I think here the more that you split it up, the more risk that you create, and again the more links in the supply chain, the more risk that there is in the supply chain.
Hey, speaking of risk, so what happens if your distributor goes bankrupt?
Yeah, I raised that one.
Thank you for
And
that, Nick.
so,
I appreciate that. Remind me to do something for you one day to return the favor. But in any event, typically these agreements have provisions that make it clear that the ownership of the inventory remains with the publisher. The fulfillment provider is a custodian of the inventory, but they do not own it, and the publisher has complete and unfettered ownership of the inventory. So, it's one thing if someone goes out for Chapter 11, it might be another thing if it goes out for someone goes out under Chapter 7. But again, that's part of your due diligence. You want to make sure that, you are examining the financial strength of the organization. It is not uncommon for a third-party distributor to be asked to provide insurance documentation each year. It's not uncommon for financial statements to be requested so that the publisher can feel comfortable that they have the right partner.
That's absolutely the right answer, David. And I'm sorry to be a Jeremiah here, but there was a case that I had where once the minute the company went into receivership, the receiver locked the doors of the warehouse and said, all of this belongs to me. And it took us 3 months to get our inventory back, even though we had clear right of ownership under the contract. The receiver just said, I really don't care. Go ahead and sue me. This is mine. I need to liquidate these assets. We got some of it out by simply backing a truck up on the morning after and taking our stock away. But it's more of a problem than it might seem to be. Sometimes the receiver will cooperate and sometimes they won't. So there's nothing you can do other than be aware of it. And if you are with a third party, the risk to your inventory and to your ongoing sales and to your cash is massive. I mean, it's one of the biggest risks. Of course, you yourself might go bankrupt, so it's always a risk in business, but it is a risk over which you have not much control. And it's happened to me twice, and it happened just last year, as you know, David, with someone in the UK. It's a real problem that one must at least be aware of.
Again, as I said, you need to prepare for contingencies here, but I think the point is that as part of your evaluation process and as part of your ongoing relationship with the provider, you are constantly checking on, you are regularly checking on these things. So you're not going to leave it until something happens. It's part of managing the business day to day. And if you're going to do this, and I think that other providers on the call would agree, that there's regular communication with the provider. You're sitting down, whether you're at Maple or you're at CDC or you're at Ingram, you're sitting down and saying, hey, what's the state of your business? Are you healthy? What are the challenges that you are dealing with? You want to make sure that the provider knows that you care about how their business is doing and that you're engaged. You cannot manage these relationships in isolation and then be surprised when something goes wrong. But the number of occasions that I have seen, with the possible exception of that unfortunate event in the UK last year, right? I can't recall any other occasion in my career, right, where a third party logistics provider has gone belly up.
Hey, another topic that has been coming up here is, if you think about the range of distribution options, like from your garage to full distribution managed by like an independent distributor, by a distributor, to 3PL, to owned distribution. Do you have any sorts of like guidelines or rules of thumb about what size publisher ought to be considering which alternatives?
I think it's if you're a starting publisher, right? I think a startup, you don't want to overextend yourself by signing up for something, right? You may want to have more control over the business, but as you see the business growing and you have to prioritize your use of resources, right? You may think that it's better for you to spend the money engaging with a third party rather than to be spending your money on building a warehouse and hiring a staff and buying material handling equipment and investing $200,000 a month in carton inventory just in case. There are other things to do with the money, and once you sink that money into those resources, it is gone. It is not coming back. You can't pack up the cartons and send it back to the converter, right? So you need to balance where you want to take your business and where you think your competence is. Publishers, I would encourage you to focus on what you do best. That is, winning content, right? Not focus on being the best book packer in the space.
David, what's your opinion on receivables? Did I hear you right that you suggested that the publisher might own their receivables and do the collection, or did I not hear that correctly?
No, I think that's not that's not a bad idea. It is not uncommon for some publishers. So we have relationships where we have full service, where we have order to cash, including collecting receivables, and then we have other relationships where we just do the pick, pack, and ship. Both of those work. And then we have some other relationships. So in the case of the latter, the publisher is managing that receivable process. And that's okay with us, right? I mean, we would never turn anyone away, right? Because they've said, well, we want to hold on to customer service and credit and collections, right? Credit and collections is not a party, right? I mean, it can be painful, right? And sometimes the distributor or the third party provider does not want to be in the middle of that, especially if there's a contentious relationship between the publisher and their customer.
Yeah, I'd be interested in what other people think. I mean, if you're small, when I shifted my university press to University of Chicago Press, our receivables, which had been a nightmare, improved dramatically because no one would pay us. We was minuscule. But people paid the University of Chicago Press. Once those Southside Chicago operatives got onto them, they paid up, and it was a massive difference to our cash flow. As a small publisher, we just had absolutely no clout with anyone. And so, I know BI also, I should say, years back, David did a very good job for us on collections as well. We're a different company. So it's something certainly to consider. And I know that you can do both options. So it's just it's definitely worth bringing up, as you did, as one of the things to consider.
Let's move back to services for just a minute. Steve Keener asked a question about how often transportation services are bundled in with 3PL services.
So if the it depends on the relationship, right? There are some relationships that we have where we customers ride on our UPS relationship. Or our freight relationship. There are others. So we have many situations where, so for instance, if we're shipping to Ingram or to Roman and Littlefield or somebody else like that, right? They're using their own trucking company. So we're absolutely fine with that. So it's situational, right? But typically, the more that the provider is managing, I think likely the better deal that you will get.
And what kind of transparency do people ask for in that? Do they ask for the the rates or a markup on the rates, or how does that work?
Again, it sort of depends on the situation. So, everybody strap on your seatbelt because you've got a UPS increase coming through in December, right? I think, in January for 5.6%, right, to reflect the new contract. So typically, we come to an arrangement with each individual publisher. At the end of the month, they receive a statement, right? We give them a copy of the bill we get from UPS so they can see everything involved. So it's as transparent as we can make it.
Very nice. And overseas distribution, I know there are a lot of smaller domestic publishers that want to get overseas, but it's kind of difficult. And what sorts of alternatives do you see for them?
So that's an interesting subject to raise right now. So it sort of depends on what market you're in. So if you're in the academic space, right, there's a company called Combined Academic Publishers, which is a sales representation and fulfillment operation. They have a relationship with Wiley. It's got a lot of attention. There's, of course, Eurospan. The environment in the United Kingdom, I have to say, is a bit volatile right now because of the decision of Random House to exit third-party distribution there. So it's not without challenges, but I think, it can be done. But in that particular case, what I would encourage the publishers to do is to manage the relationship by producing the books as close as possible to the distribution point, right? So the interesting thing about the cap arrangement, and I think that Eurospan has a similar arrangement with another company, is that you can manufacture the books overseas, right, close to the market, rather than picking, packing, and putting them on a boat to bring them overseas.
Now I've just been like rattling off these questions that I've seen on the right-hand side. Are there other ones that people would like to ask?
There are a couple of questions in the thread about smaller publishers and how they can, particularly startups and the like, how they can be well served. Aisha rather is asking something along those lines as well, for both being small and distributing internationally.
I mean, I think in that particular case, my inclination would be to go. So when you're distributing internationally, you're trying to sort of spread your wings. I think that, to me, would, if I were having to make a decision, I'd be looking for a relationship where I can get the sales and marketing and fulfillment from a single source. So, a company like IPG out of Chicago or Ingram certainly are very capable of doing that. That is not something that we do at Books International. We do not have a sales and marketing force, but other companies do, and it can be quite successful.
Yeah, and as a parallel, Jen's making the observation that the fulfillment for smaller publishers is particularly problematic, and that that there are a number of instances where companies are either not getting representation or it's cost prohibitive from somebody who's just got a few titles to work with.
Yeah, I kind of wanted to stay away from the pricing discussion around like fulfillment by Amazon and different rates there. But that's got to factor into it. If you don't have a lot of volume, maybe you're better off paying a higher fee to manage it and avoid the fixed costs. Maybe not.
I mean, I would think that is the case. Remember that this is a situation here of scaling up. So sometimes when you're at the starting point of building a business, if you want to get the business mobilized, if you want to make the business visible, you don't have a choice but to go with, an FBA relationship, right? But again, you have to just bear in mind that there may be certain tipping points, where you decide another strategy is more valuable and will help you be successful.
Hey, if Kathy, if you're still on, you've listed some acronyms around different kinds of stock management, like print to order, print to stock. Could you run through those for us?
We use ASR for automated stock replenishment. That would be if you hit a certain stock threshold, you automatically reprint a certain number of cartons full. We use POD, which also means PTO. So POD is print on demand, but a large provider we use calls it PTO for print to order. And then in the UK, we also use ZI for zero inventory. I think I got them all. Oh, short print run. SPR is for short print run.
Okay.
There's one, Kathy, I think you may have left out. It's called, and I mean, this is the thing that as a third-party provider that drives us crazier than anything, and that's called FISH, right? If you may be familiar with the acronym, which is first in, still here, right? The number of pallets of inventory that are unsold, that is a third-party distribution nightmare, because the space that that inventory occupies is, you know, unavailable for other customers. You know, and one of the things that,
sorry,
I'm sorry, go ahead. No, what I was going to say is that one of the things that we try to avoid like the plague, you know, is a prospective customer bringing in, you know, legions of unsold of just in case inventory, right? And we avoid that like the plague. The last thing we want to do is to have to build a new warehouse, right, to accommodate unsold inventory.
So I was going to make a crack about the other inventory policy of OSWO.
That's a new one on me, Tom.
That's
Go ahead.
Oh,
What is
shoot, we're
OSWO?
out. It's oh shoot, we're out. So there you go. So Kathy, we just added to your inventory management vocabulary there.
I'm not sure that shoot was the word you had in mind, though, right?
It wasn't, but hey, this is I wanted to make this a PG rated call here.
Okay.
Have you seen any smaller publishers going in to do like a co-op for distribution and to share resources?
I have not run into that, but I don't think it is an idea without merit. But I think what I would probably try to do there is to see if there's a way that you could do it under the umbrella of a trade organization. I don't know about the legal issues there, but an IBPA or a PubWest, you know, might be a way to do that, or a PCPA, Protestant Church Publishers Association. Again, I think you'd have to check the legality of it. But, you know, the problem, I think the challenge there would be that the more custom that the policies and procedures have to be to accommodate the expectations of individual organizations, more likely it will be expensive, and the more likely a third-party distributor would say, no, this is more, you know, more than we want to contend with. Because again,
Yes,
remember, if you're smaller, you don't have the volume that can allows you to perhaps negotiate that range of services that you want.
That's right. Although they weren't small, I think Trilegent got started that way. They were large university presses, though.
Triliteral, I think,
Triliteral,
right? So,
Triliteral.
yeah. So that's now part of the Lakeside Group, right? That's right. And but I think that there was a commonality of purpose and a commonality of market there. So I think, you know, that would be different. I think the closer, I think trade organizations may have a tougher time with something like that than university presses, which are serving a common customer base.
Yeah, David, when I was running the IBPA board many years ago, when it was PMA, I advised strongly against it. It did come up. I think for a trade organization to take that on would be catastrophic. It's a very specialized, I mean, logistics, as you've said, supply chain logistics, all of this is very specialized work. And even with everyone working together for a common goal, it's not easy to set up this and run it. especially with a lot of different publishers, and they might all agree to start with, and then they fall out, and then your best one leaves and goes somewhere else, and you don't have the volume. I don't think it's a good idea. I think you need.
Well, I mean, so let's take something, a very simple example, right? So if you have a situation like that where you have a cooperative organization, does the co-op issue, say there's a transaction to a particular bookstore and there are, books from 7 publishers there, right? And does the co-op issue one invoice covering the 7 publishers, or 7 invoices covering each one publisher, right? If in the case of the former, if the bill comes in and if the invoice goes out and it's for $1,000 and the payment comes back and it's for $800, how is it applied, right? Who gets the cash, right? So, I mean, it could be immensely complicated. So these are all factors that would have to be considered to do that.
Very good. All right, so we're running down on the hour here. This has been a great discussion. Brian, do you have any? And David, thank you very much for doing this and for everybody's active participation here. Brian, do you have any final comments?
No, I was just going to throw out, in the context of the triliteral discussion, that certainly University of Chicago Press is also a good example, not so much of a co-op, but of a single purpose or a more focused distributor, serving a specific audience. But I wanted to thank you, Ken, and David, of course, for putting this together. You can see in the chat, and it continues to kind of build, that there's a lot of thoughts. We'll capture the chat and make sure that it's available for folks. There were answers to questions from various people participating that we did on questions that we didn't necessarily get to, and we'll share that after this is done.
Great, so thank you, everyone, and look forward to seeing you next time.
With that, folks, thank you very much. It's been a pleasure. And again, you know where to reach me if you'd like to discuss any of this going forward. Bye-bye
Thanks.
now.
A lot.
Thank you.
Thank you. Thank you very much.